Let's be honest, most people look at the stock market and think it's this complicated casino where only Wall Street insiders make money. But the truth is, if you understand a few simple principles and stick to a long-term plan, now you can actually turn the market into your most powerful wealth building tool. And today I'm going to give you the complete step-by-step guide for beginners in 2026 so that you can start investing with confidence without feeling overwhelmed. Investment. First, you need to truly understand what a stock is. When you buy a share, you're not just gambling on numbers moving up and down. You're literally buying a piece of ownership in a real business. Investment. Imagine owning even the tiniest fraction of Apple, Tesla, or Starbucks. If the company grows, your share of that success grows with it. Once you see stocks as ownership, investment, the market stops being this abstract game and starts becoming a long-term path to wealth. Now, before you even think about hitting the buy button, you need to build a strong financial foundation. Too many beginners make the mistake of rushing in without preparing. Here's the reality: the market will go up, it will go down. And if you don't have an emergency fund or a clear budget, the first drop in prices will scare you into selling. That's why step one is always to get your personal finances in order. Pay down high interest debt, set aside 3 to 6 months of expenses, and only then put money you don't need right away into the stock market. Then that safety net allows you to invest with confidence instead of fear. Once you're ready, it's time to focus on strategy. And for beginners, the best strategies aren't about finding the next hot stock or timing the market. It's about consistency and simplicity. One of the most powerful tools you can use is index fund investing. Instead of trying to pick winners and losers, you're buying the entire market, spreading your risk across hundreds of companies. Combine that with dollar cost averaging, which means you invest a fixed amount every single month, regardless of whether the market is up or down. And you've got a system that takes emotion out of the equation. Over time, and this approach beats the majority of people who try to outsmart the market. Finally, let's talk about mistakes to avoid, because beginners often lose money not because the market failed them, but because they failed themselves. Don't chase hype. If you hear everyone on social media screaming about a stock, you're probably already too late. Don't panic sell. When prices dip, that's when disciplined investors see opportunity, not disaster. Don't ignore fees. Those tiny percentages on mutual funds or trading platforms can eat away at your returns. And most importantly, stop trying to time the market. Even professional investors can't consistently predict when the highs and lows will happen. The real secret isn't timing the market, it's timing the market. So if you're just starting out in 2026, here's your roadmap. See stocks as ownership, build your financial foundation, choose a simple long-term strategy, and avoid the traps that scare most people away. Do this, investing, you'll discover that the stock market isn't just for the rich or the lucky. It's for anyone who's willing to learn, stay patient, and let compounding do the heavy lifting. ChatGPT said when you're starting out in the stock market, the very first thing you need to grasp is the basics. What exactly are stocks and why do they even exist? Too many beginners rush into investing thinking of stocks as just numbers on a screen, little green and red arrows that go up and down. But the reality is far more meaningful. Every stock you buy represents ownership in a real company. That company could be Apple designing the next iPhone, Starbucks selling coffee around the world, investment, or a small local business just getting off the ground. When you own a stock, you literally own a piece of that business, and your success as an investor is tied to the success of the company itself. That shift in mindset from trading numbers to owning businesses changes the way you see the entire market. Let's break it down further. Companies issue stocks for a simple reason: to raise money. If a business wants to expand, maybe they want to open new locations, launch a product, or hire more staff, they might sell shares of their company to investors. In return, investors provide capital, and those shares now represent partial ownership. If the company grows and makes more profit, the value of its stock generally rises, and so does the wealth of its shareholders. That's the foundational principle of investing. You're not just betting on random price swings, you're investing in the growth of businesses that power the economy. Now, stocks are typically categorized in two main ways. Some companies, especially mature ones, pay dividends, which are small cash payments to shareholders as a reward for owning the stock. Think of it like the company sharing part of its profit with you. Other companies, often younger or fast-growing ones, reinvest their profits back into expansion instead of paying dividends. For beginners, it's important to understand that both models have value. Dividend stocks provide steady income, while growth stocks offer the potential for larger gains if the company continues to expand. Another concept to keep in mind is volatility. Stock prices don't move in a straight line. They fluctuate every day because of news, earnings reports, economic conditions, and even investor emotions. It's easy to get caught up in the short-term noise, watching prices jump and fall by a few percent. But beginners should remind themselves that what truly matters is the long-term trajectory of the business behind the stock. If the company continues to grow, innovate, and make money, the stock price usually follows that upward path over time. And understanding the basics also means learning the difference between owning a single stock and spreading your money across many. Owning one company's shares can be rewarding if that company does extremely well, but it's also risky because all your money depends on just one business. That's why many beginners are introduced to index funds or exchange traded funds, which pool together many stocks into one investment. This way, instead of trying to guess which company will succeed, you own small pieces of hundreds of businesses, reducing risk while still benefiting from overall market growth. At the end of the day, the stock market is simply a marketplace where people buy and sell pieces of businesses. Once you internalize that, it stops being this mysterious gamble and becomes a logical tool for building wealth. Man, you don't need to be a financial genius to succeed. You just need to understand that buying a stock means becoming a business owner. And the stronger that business becomes, the stronger your investment will grow. Investment, that's the foundation every beginner should build before taking the next step. Before diving headfirst into the stock market, the most important step any beginner should take is building a strong financial foundation. Think of it like constructing a house. You wouldn't start putting up walls without first laying down a solid base. Investing works the same way. Without stability in your personal finances, even the best investment strategies will collapse the moment life throws an obstacle your way. So before you buy your first stock, you need to create a financial environment that supports and protects your investments. The first part of this foundation is financial literacy. If you don't understand how money flows in and out of your life, it's impossible to manage it effectively. Start by tracking your income and expenses. Know exactly how much money is coming in each month and where it's going. For many beginners, just creating a simple budget can feel like a light bulb moment. It shows you whether you're living within your means, overspending, investment, or saving enough to invest. A solid budget ensures that when you start investing, you're not sacrificing essentials like rent, groceries, or utility bills just to buy a few shares of stock. Next, tackle debt, especially high interest debt like credit cards or payday loans. Imagine earning a 7% annual return in the stock market while still paying 20% interest on a credit card balance. That math doesn't work in your favor. Before putting serious money into investments, pay down those high interest obligations. Not only does this free up cash flow, but it also reduces the stress of juggling debt while trying to invest. You want to enter the stock market from a position of strength, not desperation. Once debt is under control, the next layer is building an emergency fund. Life is unpredictable. Jobs get lost. Cars break down. Medical expenses pop up. If you don't have cash reserves set aside, you'll be forced to pull money out of your investments at the worst possible time, often during a market downturn. An emergency fund acts as a buffer, protecting both your lifestyle and your portfolio. A good rule of thumb is to save 3 to 6 months worth of living expenses in a safe, easily accessible account. It may feel boring compared to the excitement of investing, but this safety net is what allows you to stay consistent in the market without panicking when life happens. Another key part of a strong foundation is setting clear financial goals. Investing without a goal is like driving without a destination. You'll burn fuel, but may never get where you actually want to go. Ask yourself, am I investing for retirement, a home purchase, long-term wealth building? Knowing your goals helps shape your investment strategy. For example, if your goal is retirement decades away, you can afford to take on more risk and invest in growth-focused assets. If your goal is shorter term, you'll want safer, more conservative options. Finally, discipline and mindset are part of this foundation. You need to approach investing with patience and consistency, not as a get-rich-quick scheme. The stock market rewards those who treat it like a marathon, not a sprint. Having your finances in order gives you that peace of mind to invest regularly, even when markets are volatile. In short, building a strong financial foundation means understanding your cash flow, eliminating high-interest debt, setting up an emergency fund, and creating clear goals. These steps may not sound flashy, but they're absolutely essential. Without them, investing becomes a stressful gamble. With them, it becomes a steady, confidence-driven path to wealth. When it comes to choosing the right strategy as a beginner, the first thing to understand is that you don't need to reinvent the wheel. There are tried and true methods that have worked for decades, and the people who succeed are usually the ones who stay disciplined with a simple, consistent plan. The temptation to pick individual winner stocks or to chase the latest market trend is strong, but beginners often end up losing money that way. Instead, the smartest move is to adopt strategies that reduce risk, keep things simple, and allow you to build wealth steadily over time. One of the most beginner-friendly strategies is investing in index funds. An index fund is essentially a basket of stocks designed to track the performance of the overall market or a specific part of it. For example, An S&P 500 index fund allows you to own small pieces of 500 of the largest US companies at once. That means you're not betting on a single company's success. You're spreading your investment across an entire economy. Historically, the S&P 500 has delivered about 7-10% average annual returns after inflation, which makes it one of the most reliable wealth building tools available to everyday investors. For someone just starting out, that's an incredible advantage. You can participate in the growth of the market without needing to be an expert at analyzing individual businesses. Another key strategy is dollar cost averaging. This simply means investing a fixed amount of money on a regular schedule, regardless of whether the market is up or down. For example, you might decide to invest $200 every month into an index fund. Some months you'll buy shares at a higher price, other months at a lower price. Over time, this averages out, and you avoid the trap of trying to time the market. The beauty of dollar cost averaging is that it removes emotion from the equation. You don't need to worry about catching the perfect dip. You just stay consistent, and the long-term growth of the market works in your favor. Beginners should also think in terms of long-term holding. The stock market rewards patience. If you look at any 20-year period in modern history, investment, broad market indexes have almost always produced positive returns. But within those years, there are countless ups and downs, sometimes sharp declines. The investors who panic and sell during downturns often lock in losses, while the disciplined ones who stay invested benefit from the eventual recovery. Having a long-term mindset, measured in years and decades, not days or weeks, is crucial for success. At the same time, strategy also involves avoiding overcomplication. You don't need 10 different accounts and a portfolio of dozens of individual stocks. For most beginners, a simple setup like a broad market index fund combined with dollar cost averaging is more than enough. Once you're comfortable and more experienced, you can explore other strategies, but starting simple ensures you won't get overwhelmed. The right strategy for beginners boils down to this: diversify with index funds, stay consistent with dollar cost averaging, and commit to the long term. By following these steps, you transform investing from something stressful and risky into a steady, reliable path to building wealth over time. Avoiding common mistakes is just as important as learning the right strategies, because even a strong plan can collapse if you let fear, greed, or bad habits take over. The stock market has a way of testing people, and beginners often fall into traps that cost them years of progress. The good news is that by knowing these pitfalls in advance, you can steer clear of them and keep your wealth building journey on track. The first big mistake is chasing hype. Every year there's a new can't miss stock or trend that seems to explode overnight. Whether it's a tech company, everything makes a good investment, a meme stock, or some hot industry that everyone's talking about. The problem is, by the time most beginners hear about it on social media or from friends, the price has already skyrocketed. Buying at that stage often means paying top dollar, only to watch the stock crash back down later. Hype-driven investing isn't really investing at all. It's speculation, and it usually ends badly. Instead of chasing trends, focus on proven, long-term strategies like index funds or established companies with solid fundamentals. The second mistake is panic selling. It's human nature to feel fear when you see your portfolio dropping in value. A beginner might invest $100,000, then see it fall to $800 during a downturn and immediately sell to protect what's left. But here's the reality: market downturns are normal and temporary. History shows that the market always recovers over the long run, often coming back stronger than before. Those who panic sell lock in their losses, while disciplined investors who hold, or even buy more during the dip, end up ahead. The key lesson is simple: volatility is part of the game. If you can't stomach temporary losses, you'll never enjoy long-term gains. Another trap beginners fall into is ignoring fees. A small percentage might not sound like a big deal. What's the harm in a 1% management fee? But over decades, that 1% can eat away tens of thousands of dollars from your returns. Always pay attention to expense ratios, trading fees, and hidden costs. Choosing low-cost index funds or ETFs over actively managed funds is one of the smartest decisions you can make as a beginner. A fourth mistake is trying to time the market. Even professional investors struggle to predict the exact highs and lows, and countless studies show that most people fail at it. Beginners often think they'll wait until the market crashes before investing, or they'll try to sell right before a dip. But here's the truth: nobody knows when those moments will happen. By waiting on the sidelines, you miss out on the steady growth that happens most of the time. Consistency beats timing, which is why strategies like dollar cost averaging are so effective. Finally, many beginners invest without a plan. They put money in randomly, hoping for quick profits, with no clear goals or timeline. This lack of direction leads to emotional decision making and poor results. Man, having a plan, whether it's saving for retirement, a home, or long-term wealth, gives your investing purpose and keeps you focused when markets get shaky. Avoiding these mistakes, chasing hype, panic selling, ignoring fees, timing the market, and investing without a plan will save you from setbacks that trap most beginners. If you learn from others' errors instead of repeating them yourself, you'll stay ahead of the curve and set yourself up for real, lasting success.